Think Realty Nation, it's your host, Abhi Golhar. Welcome to the Think Realty podcast. I'm excited to be here with you today because we're talking about the data, the analytics, the information you need to become a smarter investor in the commercial space. And if you're not, if you don't have that kind of data, if you don't really know what to look at, my guest today and I, we're going to start kind of tinkering around with your brain a little bit to help you understand the data points, the migratory patterns of millennials. What's exactly happening in the commercial space, the multifamily space? What do you need to know to be smarter and take action and potentially invest your hard-earned dollars so you get the right returns and you know exactly what you're doing? And hey, you never know. Excelsior Capital might be able to help you with that as well. So my guest today is Brian Adams with Excelsior Capital. I'm excited to have the conversation with Brian in just a second, but I want to give a huge shout out to the sponsor of today's podcast, Real Property Management, which is the largest residential management franchise in North America, managing tens of thousands of properties for individuals, investors, and institutions throughout the country. Learn more at realpropertymgt.com or call 888-806-7088. All right, let's get into it. Brian, welcome to the show, man.
Thank you for having me. I appreciate it.
You got it. We've got a lot to cover, and we've got like 15 minutes. So give us a little background on who you are, what you do, and let's dive right in.
Sounds great. So I'm a native New Yorker. I married a Nashville girl, went to law school up in Boston, and have been in Nashville for the last 15 years. My wife's family has been involved in the commercial real estate business for the last 25, 30 years, and that's how I got into the business. So a recovering attorney who turned into a real estate investor. I initially started raising a series of blind pool capital funds in the traditional commingled sense, and really in the last 2 years have shifted towards a pure play syndication platform where we really focus on three things. We give accredited investors access to institutional quality commercial real estate opportunities at an accessible price point, so we have low minimums. We focus on yield generation. In my mind, taxable investors shouldn't be that focused on IRR. They can't take IRR to their mortgage payment, to the grocery store, or to their beach house. So it's all about cash on cash. And in my opinion, if you're going to take on illiquidity premium for a long period of time, you should be in that 8 to 10% cash on cash range to justify that type of risk and lockup. And then one of the things that I learned early on through my fund business is a lot of sponsors and operators and general partners, they are focused on their largest limited partners, their largest investors, which oftentimes are non-taxable pension plans, endowments, etc. And so we only work with taxable investors, and we focus on really accentuating all the benefits you get from direct real estate ownership through your K1. So we do accelerated depreciation, cost segregation analysis on every opportunity that we buy. Yep. And I have a controller in-house full-time who's a CPA with a public accounting tax background. And so we're constantly trying to advance the tax benefits of ownership. And those are the three things that we focus on. We try to keep it simple, and we buy multi-tenant office properties around the Midwest and the Southeast. Today, we run about 2.5 million square feet total. The portfolio value is probably $350 million.
Well done. And you're in roughly 10 markets, right? 10 markets across the U.S.?
We're in 10 markets, and we only are in secondary markets, which we defined as MSAs or large city areas above 1 million population, but outside of the traditional top 10 gateway markets. So right now, we're very focused on places like Richmond, Kansas City, Nashville to an extent, although it's become very expensive in my opinion.
Yeah, it has.
Those type of growth secondary markets is where we spend our time.
A great brewery scene in Nashville too, by the way.
I am familiar with it.
Yes. So you're in 10 markets. Which markets are you in? Just a couple of easy questions right off the bat. Which markets are you in, and which markets would you go to as your 11th, 12th, and maybe 13th market?
Sure. So we started out in Nashville, obviously, and we try to be very disciplined in terms of when we see cap rates and valuations getting a little out of hand, we will exit a market. Yeah. So started in Nashville. We've been in Memphis, Louisville, Birmingham, Tampa Bay, Raleigh, Indianapolis, Columbus, Ohio, Richmond, Virginia, and Kansas City, Kansas, which if you're not familiar with that market, there's a big dynamic between Kansas City, Missouri, and Kansas City, Kansas.
Yes. There's that state line that divides the. Right.
Yes,
Yeah.
the river runs right in the middle, and we can get into that's a whole different thing. But
Yeah.
we're very focused on sub-market metrics, which we can get into later, as opposed to
Sure.
just dropping darts on cities that we think are attractive. In
Sure.
terms of where we would go moving forward,
Yep.
we love some of the dynamics that we see in places like Omaha, Des Moines, Boise, those type of markets. We were looking at Oklahoma City, but given where energy markets are, we are not going to dip our toe in that water right now. San Antonio is a market that we like a lot as well.
That's fair. And we will get into some of those market factors. I do want to talk about millennials. We had a conversation a few days ago, and that was a really big topic, especially where they're buying, where they're renting, where they're moving. And you mentioned a couple of very interesting things. Give me a recap of that and where you think millennials are headed and how that's going to start driving some of even your acquisitions moving forward.
Yeah, and I'm an office guy, but this would apply to almost any food group or asset class from the commercial real estate realm, in my opinion. I'm 38. I just turned 38, so I'm just barely millennial, but I do qualify. There's certainly a narrative within kind of the broader Wall Street world that millennials were never going to buy a home. They were always going to live in apartment buildings in Brooklyn or the Bay Area. They were never going to have children, and they were going to eat avocado toast all day, and they were just going to stay where they were. Well, clearly that's not the case. The millennial generation is now 75 million people strong. It's the largest working population in America today, and it's the largest working population in America ever. So the mass migration of millennials out of these urban dense metros into secondary markets where they can have access to single family homes, access to education for their children, and quality of life and cost of living, those are really the factors that determine where folks want to live, work, and play. Now, because of '08, millennial family formation was delayed, but it's happening right now. And so I don't think there was an appreciation on the market or on the street of how large of an impact that would have on the commercial real estate industry. And it's really interesting to see in a post-COVID world that these trends are accelerating pretty dramatically. And I think we continue to see announcements like we've seen out of Amazon and Facebook and some of these large tech companies that they're really going to move towards a more of a hub and spoke model where the mothership may still be in New York or the Bay Area, but the majority of the workforce and the population will be in these growth secondary markets that I just mentioned.
That's fair. And when we take a look at remote working, and that's been a really big thing through the pandemic, and even some of my teams were like, do we even need to come into the office anymore? I'm like, I'm out, right? Like, I don't even want to go to the office anymore. I don't know what y'all do on the weekend. I don't want to catch COVID. Like, I'll just come into the office maybe 1.5 days, maybe 2 days a week. How is this affecting the commercial real estate space? Do we expect WeWork to be on the rise later down the road, maybe in early 2021, mid 2021? I think SoftBank a few weeks ago they pulled out of WeWork, so maybe that's a bad indicator for WeWork, but maybe there's some additional ground that could be covered in this remote working space. What are some of your thoughts on that?
Sure. Let's throw some facts out there. Pre-COVID, 4% of the workforce worked remotely. And I want to make a distinction between working from home and working remotely because they are not identical components. Clearly, in a post-COVID world, more than 4% of the workforce will work remotely. That will certainly increase. But to your point, this trend line that we saw over the last cycle of users and tenants going towards massive density. In some WeWork locations, it was roughly 75 square feet per user in their locations, which is really, really small. And also those spaces are very, very expensive. Now, let's kind of pull back from using WeWork because they have obviously some really big managerial issues and they were way over levered and that's a whole different story. But let's talk about co-working in general. Clearly, with social distancing and just people's comfort levels, it's going to trend back towards what was more traditional, which is roughly 250 square feet per employee and per user. Given that those two trends are going to continue to accelerate, in our opinion, it's largely a wash. And I think it will even out as users and tenants require more space, more traditional office layouts, and less hoteling, benching, and some of the things that we saw in these WeWork locations. Now, that being said, if I were a landlord of a tech-heavy rent roll in a large tower deal, I would be a little nervous, frankly. And I think suburban office, where you have lots of room, lots of parking, you don't have to worry about getting into an elevator necessarily, you don't have to worry about mass transit commute. I think a lot of those, that asset class will really thrive in a post-COVID world. And I'll caveat all that by saying we are all guilty of recency bias.
Yes.
So what we've been doing the last 4 months, we all think, well, this is going to be how the world is moving forward. And that happened after 2008, it happened after 9/11. And so we have to take that into consideration that may not be in 3 to 5 years when a lot of these leases actually roll.
Yeah.
The world will be very different. And you have to remember that in the commercial real estate world, in my world, my average tenant has a lease for 5.5 years, and they're credit tenants. So they are not making any decisions today. And moving forward, will they maybe downsize the amount of space they need? Possibly. But for now, they're locked into these liabilities and obligations. And so it's very hard to know in real time what's going to happen in that world.
So when do you expect opportunities to really start opening up, say in the suburban markets, or are they already right now? And if I am a commercial real estate investor, where do I start looking?
Right. So we've been very fortunate. We've had 100% rent payment April, May, June.
Nice.
One user asked for rent relief. They're private equity backed. It was more opportunistic than it was a real need. And so our investment thesis of more of these stabilized markets has proven out. Now we've been very fortunate. We focus on cyclical industries, so healthcare, government, financial professional services, and STEM. Obviously, if you were a landlord of travel, hospitality, and leisure, it's a different story, and you can't underwrite for that type of risk. But opportunities right now, given how accommodative the Fed and the regulators have been, we haven't really seen any screaming hot deals in the office world. So we've been continuing to leverage our brokerage network, and we focus on $10 to $15 million acquisitions, which is below private equity, but above what maybe a local syndication of investors or families can do. And, the world is coming back. Debt markets are in a much better place than they were even 30 days ago. And we're starting to see sellers that had pressed pause in Q1 finally actually move forward and start potentially selling. We're actually trying to close on that acquisition today in Kansas City. We're waiting on one piece of paperwork from a tenant. So
nice.
Knock on wood, that happens.
Man. So we have another minute or two. Tell me a little bit about the investor syndication platform that you have. You have a storied history. You have a lot of deals under your belt. You have a lot of AUM. You have a lot of assets in various markets across the U.S. How do you work with investors? What should we expect, and what's the best way to get in touch with you?
Sure. So the traditional contact points, LinkedIn, email, etc. We're very active on the LinkedIn platform for social media. In terms of where we focus and how we work with investors, I think in my experience, high net worth individuals and families are criminally underserved and underrepresented for commercial real estate office opportunities. Oftentimes, because of the price point and the debt obligations, they can only access office deals through a KKR or a Blackstone fund of funds, or a one-off opportunity that their country club friend gives them. And so we're trying to bridge the gap there and bring opportunities to the mass affluent. So we have infrastructure and a platform where we're typically acquiring a deal a quarter and raising around $5 million plus per opportunity. And we put a lot of our own capital into it. We have good legacy relationships with individuals, but always trying to expand the network, obviously.
Awesome. And the website, best way to get in touch with you?
Absolutely.
I know you mentioned social. LinkedIn is obviously great. We're connected there. The website is ExcelsiorGP.com. GP.com. So www.ExcelsiorGP.com to learn more about Brian and his team. And if you want to get involved, it makes sense. I like some of these trends, and Brian, the moment that we talked, I knew we would hit it right off because we have very similar theories about where the market's going to be, and I'm excited to see how those prove out. And you've done a really good job of taking a look at secondary markets and really entering the market well. And we'll have to have you back because we did not get to the discussion of the submarket data points that we look at. So maybe we'll have that as a part 2 interview series. Sound good?
Absolutely. Would love to.
Okay. Brian, thanks so much, man. I appreciate it.
Thank you for having me on. I really appreciate the opportunity.
You got it. And this segment is brought to you by Residential Capital Partners, a leading hard money lender with a national scope and local presence in each market they serve. Their partners and loan affiliates have flipped well over 1,000 properties themselves, so they know your business really well. Visit them today at residentialcapitalpartners.com. So Lisa wrote a pretty awesome article on thethinkrealty.com in the news industry trends section. And she was discussing the total number of rent payments that were made in May. And essentially, the gut reaction that I got was, great, more rent payments are being made in May, which means that we're slowly starting to kind of come back, which is good. Quote, national survey results show more rents were paid in full and on time in May. And the majority of single-family tenants are current with their May rent payments, and that was a survey released by NARPM, the National Association of Residential Property Managers. And this was a survey conducted with roughly 6,500 members and about 900 responses. Over 60% of the property managers reported that 91 to 100% of their tenants paid May's rent in full and on time. Another 22% indicated that 81 to 90% of their tenants had paid in full and on time. In the previous month's survey, however, 40% indicated that 91 to 100% paid on time, with 20% indicating that they paid, that 81 to 90% of their tenants were current and paid on time. So it's a good increase. What's happening in your area? I want to take that conversation and relay that data forward and see if this is accurate. So get in touch. You want to get in touch, go to thinkrealty.com. Check out the blog. You can write to us as well. You can email us. You can find me online anywhere on social at Abi Golhar. Let me know if this data is reflective of your environment and your business. And if it's not, and you're like, well, I only have 25% of my tenants paying on time and in full. This seems like a dream. Well, we would love to hear about that and share your story as well. So get in touch. You know how to do it. And overall, this was fantastic. I learned a lot from Brian over at Excelsior. If you want to get in touch with him, of course, ExcelsiorGP.com is where you want to go. To wrap up and give a huge shout out to today's sponsor, which is Real Property Management, the largest residential property management franchise in North America. They manage tens of thousands of properties for individuals, investors, and institutions throughout the country. Go to www.realpropertymgt.com. You can also call them at 888-806-7088. Again, 888-806-7088. Think Realty Nation, that's a wrap. Until next time, happy investing.